get set up.
Okay, great. Thank you very much. Well, thanks all for joining. I'm going to be talking for 40 minutes, but please do feel free to come in with questions either verbally or by message throughout the talk, or wait till the end. So my name is Chris Jones. I run Graham's London office, but also a managing director on the portfolio solutions and research side, which means I work with clients, but also work with the quant team here at Graham as well in the design and build of solutions for our asset owner clients and their consultants. My background is I've worked 20 odd years on the allocator side before moving to Graham, and also have this kind of slightly fun academic hobby job where I'm an adjunct fellow at the University of Cambridge and lecture there on hedge fund strategies to the MFin and MBA. So I'll try and not make this like a dry academic lecture anyway, and inject a little bit more kind of practicality into it. But please do chime in throughout as I talk. So let's have a go at sharing the screen here and see if we can do that. Just one moment. So you should all be able to see the headline slide, Diversification by Design Part 2. If you can't shout, because otherwise this is not going to work. But if you can, I'll jump straight in. So I'm going to be talking today about diversification. We did a talk for the previous year's GIF called Diversification by Design. And here we looked mainly at the nature of correlation and how sometimes finding good diversification for a portfolio can be counterintuitive and sometimes misspecified. Whereas part 2 of this, the talk, Diversification by Design Part 2, is going to be much more hands-on in talking about how we build diversifying strategies hand in hand with asset owners and their consultants, and how we try and build things on a bespoke basis, a customized basis for individual investors or cohorts of investors to find a best fit for their portfolio. So this is really applied diversification. But in doing that, we'll just take a reminder to check we're all on the same page with regard to what is diversification. And we're seeing more investors, asset owners, consultants look to inject added liquid diversification into portfolios, and that's very much driven by the stick of pretty dismal performance of the typical 60-40 portfolio. A less than positive outlook for bonds, for equities, but also, as we'll go on to see, kind of some important structural changes in the diversification between those two asset classes. So we'll look just a little bit at where the big stick that's coming from in forcing asset owners to look to diversify more. But then kind of we'll move quickly on to looking at where's the carrot here. What can we do in terms of building diversification strategies for asset owners, particularly downside diversification, risk mitigation, and crisis diversification. And the emphasis here will be on kind of what we've really learned in doing this over the years. Graham Capital is an 18 billion macro and systematic macro focused business. But really kind of the reason that we have this client base is that clients come to us for liquid diversification. And if you look at our asset base, almost 50% is customized in some way to really fit, to best fit asset owners' portfolios. You know, there's an argument, there's no such thing as what the best asset manager is, but a more rational question to answer is which asset manager can give the best fit for me, for my portfolio, to solve the problems that I need to solve. And so a lot of the work we do is on finding best fit. And in part of that work, we spend a lot of time defining investment objectives and working within a framework that allows clients to specify what they want and really to work with them in identifying what they want and then building solutions. So diversification, the big push that's making people want more diversification and how we approach it. And hopefully this will be of use, and at least kind of pique your thought process in combining this with your own considerable experience of working with clients in building diversifying solutions. So this is the easy slide, essentially, kind of diversification. What do we mean? Well, I felt we had to state it, and very broadly, what we mean is diversifying a portfolio is investing in a variety of different things in order to reduce the overall risk. So as a result, you get a more efficient portfolio in terms of information ratio or Sharpe ratio. You get higher risk-adjusted returns, so better returns for the same level of risk. Or otherwise a lower level of risk to generate the same returns. And really kind of the thing is to look for things that aren't perfectly correlated, which naturally will then diversify the portfolio. But this is a very contrived slide, but the moral of the slide really is what you want to get out isn't necessarily what you have to put in. For investors that think at a portfolio level and have portfolio level objectives, sometimes the things that you can add to your portfolio to better achieve those objectives doesn't look kind of like things that you would necessarily look at on a standalone investment basis. Here in this massively contrived example, I've got two assets, both of which have a negative expected return, but given the nature of how they're correlated together, generate a portfolio with a positive expected return. And later on in this talk, we'll address this a bit more, because we found that there's all sorts of drags and disincentives that make investors shy away from negative expected return assets, tail hedges, portfolio level hedges, and so forth. It's difficult to get these things approved from stakeholders and other oversight structures. And this really leads to a demand for people to have diversifiers packaged up together rather than even run the risk of sapping bandwidth and creating problems by even seeking to add a negative expected return asset such as a hedge. So later on, we're going to be talking very much about rather than just throwing together strands of diversifiers, packaging them together in a way that's much more palatable to stakeholders, to investment committees, and so forth. Also in recognition of things such as costs, liquidity, and so forth. The aim being to get the right diversifier in the portfolio, but to get it in a way that is suitable for the governance of any pension plan or other asset pool. So here I'm going to talk a little bit about kind of what a great thing equities and bonds have been. And maybe how this dream scenario is now coming to an end. So when we started doing this talk to the GIF, it was around May 22, and here are the results we had since from March 09 until then. Great returns for equities, great returns for bonds, but more importantly, great returns for 60-40 portfolio of equities and bonds. And really kind of, we cursed things since then, because since then everything's gone down, right? It's gone down, 60-40 has gone down by 6.5%, or perhaps a little bit more. And so clearly all's not well in balanced portfolio land. If you look there over the last 30 odd years, you'll see that equities and bonds weren't a bad thing at all, kind of in the 2000s, the noughties, but then become even more an incredible source of return for the 2010s. Unfortunately, it's very unlikely this will be replicated. And you might think that that's because kind of the way the economy has turned, the threat of recession, the threat of inflation, and thus negative expectations for equities and for bonds. But we'll just take a little look that actually it's as much as anything down to the effect of equity bond correlation, which has been very, very usefully negative for the past 20 years or more. If you have most asset owners want to own bonds for surety, sometimes to meet liabilities. They want to own equities for risk assets to create a positive expected return over time that helps their scheme, their pension plan, getting to keep or get well funded. And what a free gift it was that these two core asset classes were negatively correlated. It's a dream portfolio. You just really didn't need to do too much else. And particularly over the last 10 years, you know, you've seen these great both nominal and real returns from a 60-40 portfolio, and you know, not such a bad set of nominal returns from the what's called the lost decade for the noughties. But now we've got a situation where things are really driving people to look beyond a 60-40 for their portfolio. We've got negative real yields across all government bonds now. And even though some changes in corporate has meant that there's just low positive real yields, the situation of government bonds is just not really palatable to own bonds in the same way as asset owners had previously done. And it comes back again to this correlation between equities and bonds. The 1 month look back for the current correlation between the US 10-year and the S&P 500 is about plus 0.7 currently. So the equities and bonds are practically acting like the same thing at the moment. And this seems kind of like an aberration compared to what we've seen over the last 20 years. But in fact, if we go past kind of most of our kind of histories in financial markets, we see that actually a positive correlation, maybe not as high as 0.7, but certainly a positive correlation of 0.4 and 0.5 has kind of been the norm from the 60s right the way through to the turn of the millennium, and then kind of pretty much as much positive and negative as before then. Now, the fact that we've seen this positive correlation now isn't in any way spurious or just by chance. There's very strong evidence that equities look like bonds at times when bond yields are higher, as we see there. Very much a strong relationship there when yields are higher, or when inflation is higher. As we see there, higher inflation, positive correlation. And so we've currently got a situation with a negative outlook for bonds, negative outlook for equities, but arguably, but more importantly, a positive correlation for equity bonds, expected correlation for equity bond correlation. And how, whatever your view is for equities and bonds, that's going to affect asset owners' 60-40 portfolios. Here you'll see what the volatility of a 60-40 portfolio will look like as the correlation between equities and bonds increase. It will increase by about 1/3, or well, 30% at least. If you look at information ratio, and this is just with positive, this is with the positive expected returns for equities and bonds over the last 20 years. So no negativity of outlook, just the last 20 years happening again now, and what is solely the change due to correlation. So 30% increase in portfolio volatility and a 25% decrease in expected returns. And that's for this golden era of positive expected returns for both asset classes over the past 2 decades. You start to put in slightly more realistic expectations for return there. And you get much lower Sharpe ratios as well. So to recap, there's a big stick there that's making investors look for more diversification. People are maxed out on private markets in the search for yields as bonds give less yield over the past decade. And for investors in some domiciles, after pension plan managers, for example, in the UK, where there's a great challenge to LDI, something of a liquidity crisis that could still lead to forced sales and a revaluation of private assets. And so this private asset ownership is being challenged, but also the core of many asset owners' portfolios, equities and bonds, is all of a sudden very challenging as well. So there's this diversification gap in asset owners' portfolios, and it's seeking them to look for liquid, because they're maxed out on privates, diversification in their portfolios. And I think it's the case, and I feel very strongly it's the case, having been an allocator across hedge fund strategies, fund of funds manager back in at the time of the GFC, that allocators have very much now seen beyond that broad so-called asset class of hedge funds. Instead, with the guidance of their consultants, asset owners are very much more inclined now to specify what type of liquid alternative they may want to diversify their portfolio. And I think asset owners and their consultants are focusing a lot more about downside diversification rather than things that are uncorrelated on a good day, but start getting correlated to risk assets on a bad day. So if you think about it, that's the worst case return, right? When your equities are going up and your liquid alts are uncorrelated, well, that's a drag on performance, especially when they get correlated to your risk assets, when your risk assets sell off. So as a result, a lot more people are looking at downside correlation. And this tends to be taking them to, it took them to alternative risk premia, but with mixed results. But it tends to be taking them more to strategies such as equity market neutral, macro, trend following. Strategies, particularly the macro and trend following, that have a degree of convexity and have shown that perhaps not as you know, sometimes they get oversold as something that's going to make money every time risk assets sell off. I think zero correlation doesn't mean that. These are zero correlation strategies, so they have a fighting chance of making money when equities and bonds when equities sell off. But certainly these aren't insurances. They aren't negative correlation strategies. So as a result, they're going to make money for some of the time when markets sell off, but not for all of the time. And so asset owners are starting to say, well, you know, we're getting a step towards liquid diversification on the downside with these strategies, but we need more. And so for the second part of this talk, I'm now going to move my attention to how we've worked with asset owners to try and deliver the kind of more that they want, using strategies such as macro and trend following as part of a makeup of portfolios for asset owners, but equally looking to augment returns, to add other strategies as well that give greater consistency of downside diversification. And you know, a lot of you will have clients or have seen talk of risk mitigating strategies, and a lot of asset owners have been proactive in building risk mitigating strategies portfolios with sometimes what is called crash alpha or you know, downside deviation or whatever, call it what you will. But the stark reality is, in some at least of these risk mitigating portfolios, there's been a ton of bonds. And so bonds have been carrying the risk mitigating strategies. And so even those who have been proactive and done a very good job of protecting their portfolio through risk mitigating strategies, there are still now these asset owners are looking to change the nature of their RMS portfolios because of the low expectations of bonds as a diversifier going forward for at least the near future. So with that being said, what have we done to help asset owners and work with their consultants to see if we can give more than just the core strategies that we manage? Well, you know, the stark reality is macro trend following does a good job, and a range of other assets do a good job as well. But there's no one silver bullet. It was bonds for a while, positive expected return, decorrelated from risk assets, did well in a crisis. But you know, as we've seen, this isn't the case for bonds anymore. So what else can we look at? Because we have gone through the thought process with investors that, well, if there's not one strategy that does the job, maybe we can harness here the benefits of just straightforward portfolio building and diversification to find a range of strategies that can do the job. And so that's what we've done. We found that this involves a lot of time being spent specifying the problem. The delivery has been perhaps the easier part. It's been specifying the problems the past, and we certainly do not equate ourselves to Albert Einstein in any way, but we will steal some of his wisdom, or at least wisdom that's attributed to him, with this quote. If I had an hour to solve a problem, I'd spend 55 minutes thinking about the problem and 5 minutes thinking about solutions. And we've found in our journey in working with clients to help them diversify portfolio, then we need to ask a lot more questions than we had expected, and to work with investors and particularly with their consultants to specify exactly what makes the best fit in their portfolio. Because everybody says, I want something that makes money when stocks go down. But that is not a well-defined objective, because, well, how much money do you want to make? How much are you willing to sacrifice of upside in terms to allow you to achieve this in the downside? What does go down mean? Does it mean going down 5% in a month? Does it mean going down 20% over 3 months? Does it mean going down 40% in a year? Where's your pain points here? Over what time threshold, what price threshold, and so forth. And so, just as the same as the wisdom that we stole from good old Albert Einstein, kind of we've had to do a lot of thinking about the problem and working in partnership with consultants and with asset owners to build these kind of solutions. What really kind of it comes down to is once you start measuring and specifying all those different thresholds over time, over loss, and so forth, what it really comes down to is how much upside are you willing to sacrifice in order to get well covered in a crisis. But also an extra parameter that perhaps didn't used to get thought about so much, but certainly is as important as the downside benefit overall, and that's with what consistency do you want to have return? Are you happy that in 6 or 7 crises you want good performance in 3 or 4 of those, or does it need to be 7 out of 7? And that consistency question is very much down to asset owners and their stakeholders and their investment committees and their governance, because the aim is to get something that doesn't end up with the governance or the IC abandoning a given strategy at the worst possible point in the middle of a crisis. And so it has to be all about kind of well managing expectations and setting parameters for what kind of consistency as well as downside diversification that's needed. So the stuff in the toolbox, not exhaustively, but certainly kind of to a great degree, is bonds, which we've talked about already, is tail protection. So, for example, buying puts on equities, buying equity volatility. It's trend following strategies, which are notably convex, systematic strategies trading liquid markets. Macro strategy, global macro, be it tactical trading or more or longer term. Reserve assets such as gold, safe haven currencies. If you're throwing inflation protection into the mix, then you can throw other commodities in there as well. But what you see is there's no lots of ticks here anymore. This might have been bonds for a while, but certainly isn't now. So none of these are silver bullets, and instead, we need to start to look at combinations. Well, you've got all these different combinations: tail protection, safe havens, convex strategies. And just by the nature of portfolio construction and diversification, modern portfolio theory tells us that you should be able to build something with combos of these that is better than any one of them individually within certain bounds, and those certain bounds are the efficient frontier, essentially. You cannot, with these assets, ever be beyond this efficient frontier, but you can be on it by actively combining different strategies and assets. And this is what we've been working on, essentially, kind of, can we take a range of assets, both passive and active, in a straightforward and sensible way, combine them with an ongoing rebalancing program to give asset owners something that addresses and achieves their aims of downside diversification, consistency of downside diversification, and also with a realism going forward of something that isn't overly optimized or overly promising. And this approach to kind of building portfolios here takes us to a place where essentially asset owners and their consultants are empowered by the big dial that they have. And that's the dial of trade-off between long-run return and downside performance or performance in a risk asset sell-off, and consistency of that as well. But it doesn't stop there, because most asset owners have constraints in terms of what they're looking to achieve, in terms of the time frames they think of. You know, if you have an IC that's going to meet every quarter, then do you really want to be kind of trying to have consistency of returns every week? Or if you have a very understanding long-term set of governance or stakeholders that are really only going to look on an annual basis, then then probably annual is the time where you need to achieve a recovery time from any drawdown. So time frame is very important. Cost is massively important. Most asset owners find it difficult to get more expensive stuff through their governance, irrespective of of the efficacy of such strategies. But not just the implicit cost, explicit costs, implicit costs as well. You know, there's lots of stuff that's available from banks that comes at nominally zero cost, but with great amounts of execution costs and built-in, baked-in fees. And so we don't just draw the line at the fees that we would charge and being explicit there, but being explicit with the implicit costs such as slippage and so forth as to how much it costs the investor as well. And then finally, liquidity. You know, I think it's fair to say that when we started doing this talk about to GIFs 6 months ago, then liquidity was perhaps a little bit less of a concern than it is today. People really are faced with their portfolios having shrunk, their private markets allocations having grown, and as a result, much less scope for anything less than very liquid assets. And so, as a result, this is a growing challenge as well. So to summarize, as we come to the half hour now, and we can open up to questions. There's a big stick that's beating asset owners to need to find diversification for their portfolios. 60/40 is nowhere near as diversified as before, and there are negative expectations for the return of a 60/40. But even if they weren't, the 60/40 is getting more volatile and less diversified due to what's expected to be a normalization of equity bond correlation, leading to this core not being as good as it was. People had once looked to private markets for diversification and yield, but they're somewhat constrained to do that now. So as a result, there's a large movement of investors looking for liquid diversification for their portfolios. And consultants have done a great job in educating investors that they've become much more sophisticated in how they will assess what to invest with. Investors are much more specific about liquid alts or hedge fund strategies. They're much more specific about realizing that they have the right to be outcome oriented rather than to be bound by asset class, to get to choose strategies that maybe can be combined, augmented, or bought off the peg to act as a best fit diversifier for a portfolio, almost a completion fund that does the diversification. And so this growing sophistication of asset owners means that they're much more likely to be outcome oriented and specified by return stream that's needed, rather than just choose from a list of asset classes or even sub asset classes. And as a result, people such as ourselves, and we certainly don't have the monopoly on this, are able to work in partnership with such sophisticated investors to say, okay, let's specify what you want. And for us, investment consultants are a brilliant point of interaction here, because they have by far the best understanding of what cohorts of investors are looking to achieve in terms of diversification, in terms of return, in terms of time frame, in terms of cost, in terms of liquidity. So we were able to work with consultants really to say, well, you shouldn't have to have things off the peg. Let's work to give you the return stream that your clients need. And using essentially just plain old modern portfolio theory, saying that there's no one silver bullet here, but let's work together to build a portfolio, to build a completion portfolio that diversifies on the downside, that gives the best trade-off of long-run return, a tolerable long-run return that doesn't aggravate governance, investment committees, that is saleable internally by asset owners. But that's something with a positive long-run return that also can do the job in terms of not just crisis performance or downside diversification, but also consistency of performance as well. You know, a lot of people look at expected return in a crisis, but that doesn't tell you how many crises can you expect a strategy to make money in. So consistency is really the new thing that very wisely asset owners are starting to pay attention to. And so combining active strands, passive assets, it's possible to generate a return that gives a palatable trade-off between long-run return and crisis return and consistency for cohorts of asset owners. And yeah, this has been a great journey for us. But very liberating as well, to be able to take the strategies that we specialize in and work with consultants to build portfolios that really solve problems for investors. And this is where we are currently. We know that you guys are the experts at building things for your clients, but we'd love to interact, answer questions, run through client portfolio data as examples of what could be the best fit. We're open to any of the above. But in the short term now, for this last 8 minutes, I'd love to answer any questions you may have.
And I see Wayne has a question here. Wayne, you want to jump in?
Yeah, thanks very much, Chris. I just had a quick question coming back to the correlation topic, which was, you specifically sort of mentioned negative correlation. And I guess my question is it negative correlation that you're trying to look for, or is it a lack of correlation that you're trying to get? Are you trying to get to zero or negative?
It depends on what the client wants and expects, essentially. You know, very broadly, if it's zero correlation, then it's going to do well half the time, right, in downsides. And I think perhaps a lot of people have invested in trend following and think, okay, every crisis it's going to make money. But you know, that's just not what zero correlation means. So for some folk, you know, they are happy to just put together some zero correlated stuff, so long as it stays zero, so long as it doesn't have a stress positive correlation with risk assets. Zero all the time is just fine. But for others, they want to keep the levels of risk assets they have on, but they realize that it might be a choppier path. And so as a result, they want negative correlation. Now, nobody wants high negative correlation because it comes at such a cost. But you know, kind of augmenting a zero correlation strategy to a minus 0.3, or delivering kind of having a bit less upside and having something that has a greater than 50% chance of doing of making positive returns to the sell-off, they're happy to make that trade. So it just really depends on investor utility. But there are plenty of folk out there for whom zero correlation perfectly does the job so long as it stays zero. But there are plenty of people out there who want, I would say, a 0 to minus 0.4 kind of correlation.
Great, thank you.
Chris, do you have a sense of how clients are bucketing this? Is it mostly part of their hedge fund portfolio, or kind of where does it get included?
It's a great question. I think bucketing and benchmarking is two things that almost go hand in hand. Now, some people have gone down the road of having a specified risk mitigation strategies portfolio. It's there in their statutes, and that's where it sits. A lot of people don't have that, and so classification is becoming a challenge. Where do I put this? If no one's buying, hey, you can have a risk mitigation bucket, then it's going to find its way into a liquid alts portfolio just by default. Arguably it's a portfolio level benefit, and so needs almost to have its own space rather than to be crammed in an alts portfolio, because alts can do lots of different things. You can have beta plus 0.5 equity portfolios that generate are great additions to portfolios, but they're going to bomb in an equity sell-off. So it's debatable whether strategies such as this could find their way into, it should be in a hedge fund or liquid alts portfolio, but for want of a better place, it tends to sit there. That being said, I do think that investors, and I know it's a theme at Mercer as well, that people are looking less at asset classes and more at strategies. So the return would be strategy derived rather than asset class derived. And so I think newer investor thinking is kind of more or less thinking on that portfolio level, outcome oriented kind of way. And so to some extent, the walls are disappearing between buckets. But the short answer is, if they're RMS way, they have an RMS way of thinking, it goes in there. If not, then it's going to get squidged in the hedge fund and liquid alts portfolio with some higher beta stuff and with some strategies that perhaps don't look the same as this.
Thank you.
Right, and I see John's got his hand raised here. Hop on in here, John.
Yeah, so Chris, just maybe, if you look at across the customized solutions that you guys provide for clients, what is maybe sort of the most common first step? Obviously every client objective is different. Every additional strategy brings in a layer of complexity, but what's sort of the most common first step that you see in terms of what investors are doing to take a step in this direction in terms of more diversification?
The first step for our investors was to start engaging about capping equity beta.
Okay.
And so the effects of that really is, there's a good paper that we well, it's up to you to say, tell us whether it's good or not. There's a paper that we did on this, just because the initial conversation is, okay, well, can you just take out positive equity signals so you don't go long equities? But the problem is then, if for anybody with any portfolio level architecture, is the beta is going to pop out in things that kind of transiently can be positively correlated to equities, such as commodities. And so as a result, the way that you can really kind of augment things is capping equity beta. It doesn't have to be zero, but capping it at something. And that has the effect of shifting the correlation from, say, 0 for trend following to something like a minus 0.3 if you put a full cap on it. So that can push things in that direction. Whereas the next steps then was, okay, well, maybe you can add stuff to it or take stuff away. So we can add, first of all, we can hybridize stuff. So you've got quant macro as a strategy, which tends to be a little bit less convex, but a little bit more consistent. And you can combine that with trend following, which is perhaps, not the most consistent thing in the world, but is very convex, and work with clients to find out what balance do you want, and then net the signals, execute once, optimize once, and so have this nicely kind of ingrained kind of mix of the right mix of quant macro and trend. And then more recently is, okay, can we augment the tail by adding long volatility or long puts? Can we add other assets that are more defensive and so forth? So it's been that 3-stage journey essentially, and the augmentation is currently where we're having conversations.
And maybe I'll just jump in, Chris, thank you, just to add, maybe a little more color there, John. We have some clients who've given us, I'll say kind of full access to all of their underlying return streams. So if we look at like anonymized return streams for all of their underlying strategies, and have come to us, really, I'll say, with that transparency, with really clearly stated goals and objectives for their portfolios and tolerances, like what is a loss that they cannot tolerate? What is a loss that they, in some time frame? And so, really trying to distill all of those finer details. Then we can come back to them with, kind of, I'll say, taking all of the Graham building blocks and some ideas, which we then can iterate in terms of ideas that we think, might resonate with them and be, I'll say, kind of livable in terms of, kind of what that return stream looks like. And as Chris said, we had clients who came to us and said, we really want reliable, consistent downside protection. The best, the only, real formulaic way to get that is equity puts. And so part of it is layering that into an alpha return stream portfolio where those alpha returns could pay for, some of that put exposure over time. And then the overall return stream is really tolerable. You're not living with, some, I'll say, kind of line item tail protection piece that, it becomes like optically the thing that everyone is going to challenge at, the quarterly IC meeting. So some of it is, ways to bring in those types of exposures into a bigger solution where the outcome is really bringing their portfolio closer to what their objectives are.
But what do those structures look like? Is that sort of a custom fund or a custom account for those clients? Is it some combination of, customized exposures plus underlying Graham funds? I mean, what's sort of the mix that you've seen?
We can build it like, and I'll say, frankly, most of it would be like a, one-off, one-stop, stop solution. So it can be implemented as a fund of one. It can be implemented as a managed account. But we also, in theory, if you said, this would be something you would use in an OCIO framework, we could build it as a fund structure, and then you could have multiple, kind of entities investing into it. So there's a lot of flexibility, frankly. I mean, most of what we do, whether it's multi-PM macro or, purely systematic solutions, on the systematic side, there's so much availability to customize there that, even the format of what the solution is customizable, whether it's UCITS, whether it's 40 Act, whether it's in a fund of one or a commingled, BVI fund structure.
Okay.
I think there's, the fact we have a pretty core universe of what we trade. So in our quant macro and trend following, we trade 50 odd most liquid futures. And so then kind of if you throw in long puts plus long vol as well through, for example, VIX futures, then you're not getting an SMA that's challenging to run. There's no kind of vast amount of swaptions or OTC kind of anything. It's all kind of liquid listed stuff, and so as a result, it's a pretty straightforward SMA to maintain, observe, and set up.
Hi, Chris. I have a question about ESG. So today, a lot of investors are ESG conscious. So, it wasn't easy, but let's say equities are well covered. Fixed income starts to be covered by different databases with carbon print and so on. I think the hedge funds are the, let's say, asset class where ESG, it's not very obvious. And, of course, if you put ESG constraints on the portfolio, it's an additional constraint. Maybe this will have a certain impact on the return, on the risk perhaps. So how do you see it on your side?
That's a very good point. Our portfolio construction always ends up with essentially a constrained optimization. So we can, if, for example, as a ESG conscious investor, you wouldn't want to invest in fossil fuels, then we constrain that to zero and still end up with a resulting optimal portfolio. But that being said, every time you kind of reduce or remove something, there's one less tool in the toolbox. If you take out commodities, then you have slightly less to be able to deal with inflation, for example, if inflation is important to you. We've run portfolios ex commodities before. In a year like this year, they've done a little bit less well, but they're still heavily positive. We've also, on a best efforts basis, replaced equity index futures with ESG EIFs. equity index futures. The problem is there aren't enough liquid equity index, ESG equity index futures. There's quite good liquidity on S&P ESG. There's quite good liquidity on Eurostoxx 600 ESG. But then you look to, for example, Asian equity indices. There's no no liquid ESG anyway. The next level down after Eurostoxx and S&P is you get the OMX, which doesn't really help too much to represent the broader space. So the challenges are, one, no one has exactly the same views on ESG, but we can overcome that easily by throwing some constraints and still maintain an optimal portfolio, but admittedly kind of a slightly reduced one. But secondly, kind of if you are really concerned about having non-ESG equity index futures as well, there's a degree you can do there, but there's not enough ESG equity index futures yet to be able to fully do it.
Okay, thank you. So basically the conclusion is it could be done, but it has a cost.
Exactly, 100%.
Thank you.
And I think maybe just to add one quick comment there, I mean, that, we'll come to you sometimes to say, what are the ESG considerations that you have? We have other clients who've come to us and said, futures, because they're not trading the individual single name equities, and foreign exchange, meet their ESG requirements on a number of levels. So yeah, that's a conversation we're happy to have, to think about, are there strategies that we're running, I'll say where there is little that we have to do, just given the underlying instruments that we're trading. Something like our quant macro fund, as Chris referenced, is purely liquid futures and foreign exchange. There's no single name securities, no single name equities, no single name credit in a portfolio like that. I know we're coming up on time here, so Chris and I are here. We're happy to answer any other questions if folks want to stay on the line, but we will thank all of you. And I also want to thank you for the wonderful event in Toronto this past week. I was there. It was fantastic. I enjoyed it. The content was awesome, and it was really a superb gathering. So thank you all for sharing that time and for your team putting together such an exceptional agenda.
Great. Thanks, everyone.
Thank you all.
Chris.
Thanks so much. Bye-bye.
Thank you.